Hi, and welcome to the Atlantic Council's IMF-World Bank conversation on the tokenization of money and what it means or potentially could mean for the international monetary system. There has been no lack of interest in all sorts of forms of digital finance here at the meetings, but we have a great group today to actually walk through what is tokenization and, again, what it could mean for the international monetary system. With me, starting on my far right, is Hung Tran, who is a non-resident senior fellow at the Atlantic Council. He's had many guises before that, and brings a great deal of depth to this conversation, has written on it. We have Siddharth Tiwari, who again, also a luminary, who's now with the Bretton Woods Committee on the advisory board, has a great career at the fund and also at the BIS. And then Faryar Shirzad, who is the Chief Policy Officer at Coinbase. Again, many different guises before that, and again, from Coinbase's perspective, brings, I think, an important dimension to this. So thank you for joining us. We have about 45 minutes today, and I'd like to get started with Faryar. What is tokenization?
It's a great question. It's the best question to start with when you're talking about crypto, tokenization, stablecoins, which have been a big part of the discussion at the IMF-World Bank meetings this week. So the way to think about it is that what the internet was able to do was an enormous technological breakthrough, and that is to allow us to transfer data. That data initially was like an email or a website. Eventually, with improvements in the tech, we could transfer voice, pictures, images, do live streams, and the rest. What the internet has not been able to do is to allow us to transfer unique things of value. So if I send you a photograph of $1, you can make infinite copies of it through traditional internet technologies. Crypto allows you to create a unique digital token and transfer it. And that token can be a stable coin, which is a token representing currency, or it can be a token representing a equity stock, or it can be a bond, or it can be an auto title, it can be Bitcoin, it can be any number of things. And so the issue that's on the table, particularly with the United States having passed the Genius Act, which creates a stablecoin federal regulatory regime in the US, and the US administration's aggressive move to on tokenization writ large, is what aspects of the traditional financial system will be tokenized. And the big first movement is on the currency, and then eventually you're seeing the SEC, for example, in the U.S., very much encouraging groups like ours and others to tokenize the equity markets, and so on. So there's a lot of innovation happening. It's a very exciting time.
So, I mean, the MD started her comments on the digital panel yesterday saying that the future of finance is digital. But I want to bring Siddharth into this from, I guess, from a regulatory perspective. What do you see? What do you see as the bedrocks of working with crypto versus CBDCs versus stable coins? Is there, how do you think about this from sort of a larger philosophical perspective?
So maybe just to step back a little bit, and I sort of look at it in a 3-1-3 perspective, that there are three functions of money, and they've been there since the time of David Ricardo. It's a unit of account, it's a medium of exchange, and it's a store of value. And that's largely remained unchanged over hundreds of years. The one is a fact which has prevailed since the Civil War in the United States, that 10% of money is public money and 90% of money is private money. If you went down, even in the corridors of IMF, and you ask people how much of money is private money, they'll probably tell you 6-7%. It's not the case, right? Through history, 90% of money after Civil War has been private money, and no one realizes that $1 in DC is $1 in Tokyo, Hong Kong, London, and it's got there through a regulatory apparatus safety nets in terms of deposit insurance and other things, and supervision. So how does this function? It functions on three characteristics. One is the singleness of money, meaning it has the same value everywhere. There's no discount. At the time of the Civil War, there were 30, 40 different kinds of money that were floating around with different values. And the singleness allows it to be a unit of account. There's finality in payments, and which means when I pay you, that's going to happen, and which means there's a regulatory system out there where the central bank can intervene to provide liquidity for the transaction to be completed. And the store of value is where I'm certain that the money remains, there's financial integrity, there is financial stability. I think these things need to translate from the analog system to the digital system, but the digital system doesn't have functionality, so we can come to it a little bit later. Several countries in Asia, Latin America, have digital systems that are akin to the fastest systems on earth, but they don't have functionality. Tokenization takes it one step further, that you can put in conditional smart contracts. So the way to look at this in terms of regulation is, does new forms of money provide singleness or not? Mm-hmm. And if it doesn't, what needs to happen? Does it provide for finality of payment? Is there central bank intervention with discount or intraday liquidity to let that transaction complete? And whether there's financial integrity and financial stability. And we can come to these separately later.
So those are two excellent launching pads to my next question to Hung, which is, we've benefited in the United States from the dollar being the dominant reserve currency, and part of the conversation here has been reflecting on what digital currencies will mean for the future of the dollar. I mean, if you look particularly at stable coins and and sort of the rapid direction of travel towards stable coins, you have 97% of those transactions are linked to the U.S. dollar, and so other countries, understandably, have been reacting to that. So I think there is a geopolitical part of this. If you have a dollar-linked stable coin and you have a closed, a country with capital controls where where there are people wanting to get that money out, there's obviously there's a potential for a conflict, or any other reason that some country or company or individual does not want to use the dollar. So can you just take us through that?
Excellent question. But if you allow me, I would like to also add a little bit to the background and the context of why we have this topic of discussion today. There's a lot of talk about stablecoins all around in the past few days, and therefore the title of this session is really more generalized and more broader. It's tokenization. And in my view, it is really reflecting to one, you say the geopolitical context is one, but the other one is really the technology has advanced to the extent that it really put in question whether or not we should really upgrade and improve the global payment system so as it can be cheaper, quicker, and less cumbersome than it is now, particularly when it comes to cross-border transaction. And the pressure has been on for many years. Central banks, incumbent commercial banks are under pressure to up their game to provide a better service. And we have seen that in many countries. And later we can talk about the experience, in my view, of an excellent situation in India, where they are really leading all other countries, including this one, US, in terms of real payment transaction as a share of total transaction. But anyway, the pressure is on. And therefore, we look at the situation of tokenized monetary units, not only stable coins, even though stable coins benefiting from the Genius Act, probably have captured the first mover advantage and probably will grow quickly in the future. Many people expect that in 10 years' time it will be somewhere from $300 billion outstanding to between $2 to $4 trillion in outstanding. It could happen. However, there's other instruments. And I think that in my view, a strong contender to this is the tokenized bank deposit. Many banks already tokenize their own deposit, which allow deposit holder to do the same thing as they do with stable coins. Transact 24/7, instantaneous settlement, doesn't have to go through intermediaries anymore. And a few days ago, Bank of New York, which has about $55 trillion of asset in their custody, every day see 2.5 trillion flow through their balance sheet, is now planning to tokenize that flow. So that alone will really push the bank tokenization of bank deposit significant forward. So in the future, I see an environment where stable coins really has a key role, but tokenized bank deposit and central bank digital currencies, which we'll get into more later, kind of competing but complementing each other in a landscape where the user at the end of the day, the retail customers, will have to decide which one they embrace and which one they prefer. So that's one competitive pressure to improve, which is benefiting all of us. But the second point you raise is also valid. We are in a geopolitical contentious situation. The dominant role of the dollar has been put under question, also because of the perceived weakness of policy making in this country, fiscal deficit, public debt, and so on. The US has been reacting to that by pushing and promoting stable coins based on the dollar. Because the more people, not only in this country, but internationally, use dollar-based stable coins, the more the role of the dollar will be kind of reinforced, and it will remain the preeminent currency in the world. And I think that is another context where this race or stablecoin race or tokenization race will happen. Other countries have reacted to that. Europe has been, the Central Bank of Europe, ECB, has been pushing the European Central Bank digital currency, the euro, the digital euro. But the problem is that, culturally speaking, the people in Europe and their politicians have been very skeptical of any form of digital currency, not only digital euro, but even stable coins. And therefore, you see that right now in Europe, stable coins denominated in euro is very tiny, 1 or 2% of the total. Legislation, parliamentarians have been reluctant to authorize the ECB to go ahead and issue the CBDC. But under the pressure from the US, from the Genius Act, we have seen in recent weeks and months change in that skepticism and attitude from Europe. And a group of 9 banks in Europe already banded together to issue euro-based stablecoins. And I think that personally, I think that in the next few months, we could see movement in European Parliament to authorize the ECB finally to make progress on issuing euro ABCD. And then if you look at China, until today, China still prohibits the use, the trade of any crypto assets, including stable coins. They prohibit banks from engaging in those activities, in investing in them, or in exchanging those crypto into the fiat currency. But now they are relaxing a little bit, and they probably will make use of the fact that Hong Kong has passed legislation to allow the issuance of stablecoin, either based on Hong Kong dollar or US dollar or yuan, as an experiment to get into the game and not leave the US kind of monopolizing the whole stablecoin space. So I think that in the future, as I said, there will be different instruments coming to the fore, and the question remains open as to which one will really be embraced by the public and become the dominant instrument.
Okay, so I want to touch on some of the issues that you just teased out, and particularly with the different approaches, what the potential risks of fragmentation are. But before we do that, there was actually the the Global Financial Stability Report that the IMF put out just for these meetings that actually looked at some of the risks with digital currencies, with stable coins, and some of the issues that they flagged, and the MD herself said that it's the role of the IMF right now to sort of flag issues and provide guidance as opposed to any other foundational role in digital currencies. But the red flags were threatening traditional lending, hampering monetary policy, or triggering a run that would be that could challenge financial stability. And I wonder if you've clearly walked through and talked through with many policymakers around the world who might have questions that are similar to what was raised in this report. What are your views? Are those real risks? Are there ways to mitigate those risks? And I'll start with you because I think you're actually in the business and getting these questions from policymakers.
Yeah, I think what Siddharth said at the outset is really important to underscore. Most money that's in circulation is private money that's issued by commercial banks. Commercial banks are extraordinarily risky entities. They exist to intermediate credit. They engage in fractional reserve lending, and they fund that lending off of deposits that they take from the public. And the reason why the system works is that, as Siddharth went through, there's a whole complex of regulations, supports, subsidies, backstops, liquidity, provisioning mechanisms, all designed to maintain this edifice and keep it in place. Stablecoins are actually a very simple business model. If I'm a stablecoin issuer, you give me $1, I give you a tokenized dollar, and then you're free to use that dollar like you would any other dollar on crypto and blockchain-based infrastructure. That business model, what I do then with that dollar you've given me is I invest it in short-dated U.S. Treasuries, and then I earn the interest on those Treasuries. It's an extraordinarily lucrative business, but it's also an extraordinarily safe business model because there's no credit risk that the stablecoin issuer takes on in the way the banks take on. And so when you're looking at the riskiness of a stablecoin and when the official sector talks about run risk and all the rest, it's really a policy decision in terms of what the regulatory expectations are of the issuers so that you can mitigate the run risk that exists with stablecoin issuance, but is 100x present in the creation of private money. And one of the ways to do that, for example, is the Genius Act's requirements on maintenance of highly liquid reserve assets, audit requirements, transparency, disclosure, redemption rules, federal regulatory oversight, and so on and so on. The Bank of England has actually contemplated that the reserves would be held at the central bank, which is actually a way to up-level it. The European Union, in its MiCA regulation, went the other direction. They've actually introduced enormous amounts of bank credit risk into the stablecoins because they've said if you're a stablecoin issuer, you have to maintain the reserves in commercial banks, and no more than X percent can be maintained in any one European regulated commercial bank. So if you have any scale developed on euro stablecoin issuance, you have to have 15, 20, 25 European banks to hold the reserves in, introduce all that credit risk into the stablecoin, if you can even find enough banks to hold the reserves. So it's a really important issue to talk about the risks associated with stablecoins, but it's really a policy matter. Genius is probably the right answer. The Bank of England's central bank accounts are another answer, but it's an infinitely soluble issue, and we're eager to be a part of that conversation.
It sounds like you've had that question before, so very well done. Given Siddharth, you've been on the IMF side looking at issues and also the BIS. Are there other concerns that you think are noteworthy that we can't mitigate, or we're at such early days that we're going to have to sort of work our way through these challenges as they arise, and then mitigate them, which could be a bumpy ride. But I'm just from a supervisory perspective.
Somewhere in the middle, right? So the first day when you go to a supervisor school, they tell you that Napoleon said that please go slowly because I'm in a hurry. And reaching your goal is more important, and not having an accident on the way is more important than going fast. And so I think just to pick up here, singleness is really, really important. The public needs to have trust that a dollar is a dollar, or an Amazon dollar, or a Walmart dollar, or Coinbase, or others. They're equivalent, they're traded on par. And when there's a shock, as happened with the Silicon Valley Bank, some of these instruments traded, they were not trading at par, they were discounts on the instruments. And that cannot happen, period. It cannot happen, because if that happens, you're not in a civilized banking system, right? So that's the first thing. Second is, when you have large value transactions, should issuers of stable coins. So on the first one, what you said is one way to go. Put all the reserves into the central bank, as the Bank of England had said. Make sure they're high quality, i.e. treasury bills, so it remains a means of payment. If there's no interest, it's not competing on the other side. Second is to ensure that if it is a means of payment, there's finality. And in this, I think the debate has just started whether they should have access to central bank facilities or not. And there are two sides to it. There's a moral hazard side, but there's also a financial stability side. And that collides, and it needs to be worked through. That conversation needs to go on. I think in terms of financial integrity, pseudo-anonymity on a blockchain is not enough, will not satisfy KYC functions cross-border, or even to start with. So that sort of needs to be solved. I know it protects privacy, but it absolutely needs to not compromise on the integrity space. Then is monetary sovereignty that other countries worry about. But that to me it's worrisome if you take a platform off the shelf and use it. You lose your monetary sovereignty, and no country should lose their monetary sovereignty. But if you're smart, you can build it, you can code it onto your platform through which someone will need to come. So things like KYC, things like capital controls, and they've gone through it in CBDC already. So you can code all of that in. I think there's an issue whether this will crowd out smaller investors in the treasury bill market, especially in this country, or whether large positions in the treasury bill market would be destabilizing. That's something out there.
Or if you actually are, from a treasury perspective, building out your curve and issuance based on where the demand is going to be in the short term. There's actually that provides a different dynamic for managing a treasury curve.
Absolutely. And then the last thing is, are there going to be spillovers cross-border from financial stress in one country? But all of these are solvable. But I think the conversation needs to start, but it needs to go step by step by step. And something what Hung said is really important. The other side of this is, for 100 years we've had a system, 10% of money is public money, 90% is private money. Why not tokenize the whole thing?
I think that's what the U.S. is doing. I mean,
Yeah.
looking at tokenization writ large. Which, if I could, I mean, it's a very good point, and I think the discussion this week in IMF-World Bank has been heavily around tokenization of payments.
Right.
But I think you alluded to it at the beginning. The really interesting dimension is once you have a tokenized settlement mechanism, it gives you lots of opportunities for creating efficiency, but the programmability potential of tokenization, whether it's derivative contracts or any number of transactions where you could create a smart contract interface that we could use to intermediate our activity, and then the tokenized payment or the tokenized asset that transfers can be executed through the smart contract, and then through agentic AI mechanisms that need a digitally native payment instrument. And I think the potential is enormous. The only thing I would say, Heidi, if I could, on the issue right now, I think the U.S. people think about what the U.S. is doing under the Trump administration as an effort to try to create legislation to grow crypto. The reality is there's about $300 billion of stablecoins in circulation. They turn over on the order of 4, 6, 7, depending on how you do the math, $1 trillion annually. About 230 billion of that 300 billion of U.S. dollar stablecoins in issuance are issued ex-U.S. by non-U.S. issuers not subject to U.S. regulation. So what the Trump administration is doing is less trying to grow crypto in the United States than bring crypto home and have U.S. dollar stablecoins issued in the U.S. And there's an urgency to that because in Singapore and the UAE, other jurisdictions, they're trying to create regulatory frameworks to encourage U.S. dollar issuance outside the U.S. And I think Siddharth's point about caution is the right one, but the countervailing fact is that this innovation is taking off, and there's not all the time in the world, and countries strategically have to decide how much time they genuinely feel like they have before they adopt the new architecture.
So that brings me to the next point, which is what in terms of how different countries are actually building the architecture, and how the regulatory systems are actually looking to manage this, leads to fragmentation, and how if it is going to be a dollar-based stable coin that is the dominant stable coin, and it is being issued outside, how do we think about that, and getting to fragmentation as my next question to Hung. Can you lay out what the challenge is and what potential solutions are?
It's easy to describe the challenges. It's not easy to offer ideas of solution.
The whole benefit is sort of the ease of cross-border payments.
So the benefit is clear: ease of transaction, 24/7, programmability. But those benefits can also be risks. The ease of transaction, 24/7, means bank runs if it happens. In the past, you have to queue up in front of a bank branch, 5 o'clock in the morning, wait, and then take money out. Now you just push a button, and then millions of dollars can run away from bank deposits into CBDC or stable coins or whatever. And I think that is the main objection that many politicians in Europe has against a European central bank digital currency. The threat to destabilize and disintermediate the banks. That's number one. Number two is the fact that stable coins are not all the same. Exactly, 100%. It varies depending on the strength of the issuer, the skill, the management ability to really make sure that the reserve that they manage, the liquidity risk that they manage, can justify one-to-one matching all the time. Perception will come when people say, this company issuing this kind of stablecoin probably is not up to the task. And therefore, we have different stablecoin trading and not at par. And that violates the singleness of money that Siddharth raised, which is an important part of money. Another risk is digital dollarization. Many countries outside of, even including Europe, but mainly developing countries, are now experiencing the fact that many of their own citizens are having access to stablecoins and using stablecoin to transact. And they cannot accept that because sovereignty means, including monetary sovereignty, means they are the guardian and the issuer of the fiat currency as legal tender in their country. So those are the risks that we mentioned. They are solvable, but they need to be raised, discussed, and importantly, for cross-border activity, they need to have international cooperation to come up with that kind of overall framework. Now, when we talk about cooperation, that's where fragmentation comes in. So given the geopolitical competition, which we don't need to go into, but we understand what it is, trust is in short supply. If you don't have mutual trust, you don't have the perception that what you agree to do is mutually beneficial. You see things as zero-sum game. What the other party is doing or achieving is at my cost and my disadvantage. Then it's very difficult to coordinate. And therefore, you see already divergent development between three key players, US, EU, and China. Each has evolved different requirement and rule and legislation. For example, the MiCA Act in the EU market in digital currency. It has very strict requirement for issuer of stablecoin based on fiat currency. It has to be registered as a bank or as a digital monetary institution in the EU. It has to be physically located in one of the EU members. You cannot issue, like in the case of stablecoin that Faryar mentioned, dollar-based stablecoin, somebody outside of the US, but issuing most of the dollar-based stablecoins will not be accepted in the EU. Very strict control. And therefore, in the view of many, can raise the problem of in the future, will dollar-based stablecoins issued by US-based company be allowed to be used in EU or not? Because my non-lawyer reading of the MiCA rule right now is that it is not. It is not being issued by a EU-registered bank-like institution. So that raises the divergence of regime. China is China. They will issue CBDC mainly to enhance the monitoring and the control of the use of currency by their people. And that's why many other people, including here in this country, are really against the idea of CBDC. So we have that kind of animal growing. And in the US, Faryar explained it very well. So in a few years' time, you see these three regulatory regimes probably diverging even more. And the technology behind it also diverging more in terms of standards and requirements and so on. So at the end of the day, the major impact on the international financial system is that this divergence, accentuated by the geopolitical competition, will further fragment the international monetary system. So instead of one big interoperable system that will expedite transaction, you have more, at least three segments. And how the three communicate with each other is subject of another big debate.
So so instead of having a big, global FX market, we actually are constraining ourselves more by having this fragmentation. And correct me if I'm wrong, but I think China had a very strong early mover preference for CBDCs and then has since moved more recently to looking at yuan-based stablecoins. And they already have, huge facility in Alipay and WeChat Pay, and so they're highly digital when it comes to payment systems. But it looks like there's some interesting changes that the Chinese are undertaking.
That brings to us something that we have not talked about so far is not only stablecoins, but at the end of the day, what user, corporation, and retail customer want is ease of using it, cost of using it for transaction, and whatever system that satisfies those needs, they will not look elsewhere. And in the case of China, Alipay and WeChat Pay accounting for 97% of all mobile transactions in China, more than 1 billion members and users. People are very happy with it. So they don't need anything else. And therefore, the test case for CBDC that People's Bank of China has been launching is now kind of being stalled and slow because people don't need it. Yeah. Same with India. India has a system that I hope Siddharth can explain to us later that allow unified payment interface. People can use their phone to exchange bank balances instantaneously. With that, they don't need CBDC. So the Indian CBDC, rupee CBDC is also languishing as well, and they don't need stablecoins. So I think that back to the original thing is really modernization of payment system, and country system that can offer a solution that meet the requirement will move ahead.
So how does this all impact your business model?
Well, Coinbase is the largest comprehensive crypto platform in the world. So we are obviously an exchange that people can come if they want to buy Bitcoin or Ethereum or for investment purposes. But we're also building the next generation of the financial architecture. So we have a layer 2 protocol that's the platform on which most developers in open source code software development are building next generation applications. We're also a significant investor in USDC or Circle, and we have a commercial agreement with them. So our view is, as adoption increases, Coinbase will be a part of building the architecture of the future. So we feel very good about the role our company is going to play. I think on just Hung's point, I think it's right. I think the Europeans could decide that they want to maintain a 20th century payment system in perpetuity. I think they have that option if they want to do that. I think what you'll see is exactly what Mario Draghi wrote about and what we've all observed anecdotally, which is anybody who's creative and has ambitions to build next generation Web3 based blockchain applications to upgrade the current internet applications will get on a plane and come to do it in the United States. And I think that's a decision Europe has to understand that they're making.
Well, I want to give you, since you've been tagged by Hung to talk about India's payment system, I think it's actually a really interesting story because it actually solved a lot of very long historical challenges that India faced. So do you want to give like 2 minutes on what?
Yeah, sure. So I think what happened in India was that the web was used to digitalize, not tokenize, digitalize the payment system. So it's a pretty neat system. It's open 24/7, 365. It's instant. It's costless. It's big tech, fintech friendly, unlike China, where there's a competition between Alipay, WeChat Pay, and PBC. And it settles in fiat money inside the regulatory system. And it's the first example of large-scale fintech companies, Google Pay, Apple Pay, WhatsApp Pay, settling inside the regulatory system. And they're very happy with it. They're extremely happy with it. So fast forward, what did they do? Financial inclusion is a big issue, that if you don't have access to finance, and I lived in Hong Kong, and SMEs and taxi drivers and others didn't have access to finance. So it's not so much a developing country issue or advanced economy issue. It is an issue of whether you have history of financial transactions, can you post collateral, and those problems are the same in India. Over a 10-year period, the gaps between men and women, educated, uneducated, urban, rural, employed, unemployed, their access to the financial system decreased to single digits, the largest decrease in the history of maybe the last 100 years. And that's massive. So today you have, I could just take out my phone, it's interoperable, I could transfer you something and you'd get it in under 1 second. Singapore has the same thing. I think the governor here said that they're not looking to tokenize at the retail level because a retail investor is not going to go between tokenized deposits and what they have. The other place where it's really helped in India, which I think is useful for United States and advanced economies, is that 2 segments of the population find it very difficult to get loans. They're the poor, who don't have a track record, and the young who have no collateral and track record. In the Indian system, because they were transacting something what Bent Holmstrom called, for which he got the Nobel Prize, what he called information capital began to develop, and that lessened the dependence on physical financial collateral. So information collateral slowly crept its way in, and you're seeing financial intermediation going on without the traditional guarantees that need to be posted. My sense is this is probably where a lot of Asia will go. But it allows you to do it because they have a fast payment system. The US doesn't, right? I mean, it takes days for me to move money to you.
We're still writing checks.
Yeah.
But that's good for the banks because they can enjoy the free float in between. So, but can I add one thing to India?
Yeah.
Because my understanding is that one key prerequisite for this UPI system to work in India is the digital identity that has been implemented as public goods for India, requiring two-factor authentication. So with that done, everyone have now a short digital ID. Banks feel comfortable in getting into this kind of transaction because they know that this is indeed my customer and that is indeed the payee that this customer wants to send money to. So without that digital ID system, it's not easy to imagine this kind of thing works. And then digital ID is something that probably not easy to translate to other countries because different culture, different social perception, people might not like that. So it has more requirements.
Yeah, so I think what Hung is touching on, I don't think we're going to have time to dwell on it, is the governance of data.
Right.
And that's a whole big issue that you can go down the line of tokenizing and better KYC requirements that allow tokenized assets to move really fast. But who is going to control the data? Countries want sovereignty of data. Is it going to be in the cloud? Where is it going to reside? And that, I think that conversation is even more primitive than the conversation we had.
It'll be interesting just because I think generationally you have, the next cohort coming up. I mean, we're all old folks at this point, but the next generation coming up they have a different perception of privacy issues, what they're willing to share. But I mean, you're right. That is a whole other panel.
Next year we can have
next year.
data governance.
I do appreciate the fact that the whole story that was India's digital payment story. It also helped with anti-corruption efforts.
Right.
It was so easy because you had so many people that everyone had a phone, but not everyone was literate. And so it was very easy to interact. And so I think people think about this debate on stable coins and crypto and CBDCs, but that's more of a developed market conversation. But there's a huge potential for developing and poor countries as well. So we are getting towards the end. I want to just do a quick round robin on anything we didn't cover that you think would be really important for people to know about tokenization. So starting with Faryar.
Well, I think Siddharth said something very important, which is the identity issue. At the moment, you can tokenize identity. You can also tokenize KYC verification. So we are and others are looking at models of allowing people to trade tokenized equity, for example, on what are known as verified pools that you can only engage in if you carry a KYC token that you've gotten by virtue of being onboarded at us or JP Morgan or Wells Fargo or whoever the KYC review took place will issue a KYC token. So I think a lot of these issues are resolvable in terms of, and the technology's there to do it. I would say in terms of UPI, just like PIX, they're extraordinary advances, but they sort of harken back to 1997 when we had a debate on whether we need an internet or whether we need an intranet. And the question is, do you have a government-regulated, walled garden, static technology that solves the problems of 1998, or whether you have a programmable, open source public network that people can innovate and build on? And I think history will ultimately reward those like the United States who have picked the internet model that allows for people to build and program and the next generation of innovation.
Siddharth.
So I think this is a debate between retail and wholesale. In the retail space, the jury's out whether it gets tokenized or not. Most of Asia looks like it will not get tokenized. In the wholesale space, which is the backbone of the financial system, there's no question that tokenization would help. The BIS is looking at something called a unified ledger, which is going back to the beginning of this conversation, that if you have 10% and 90%, why not tokenize the whole thing? So tokenize public money, CBDC, tokenize bank deposits, tokenize the equity market to serve as collateral that you can get credit with. And so as you go down the line, once it gets tokenized, it'll be super efficient. And you'll look, I have no doubt, you and I will get tokenized in 15 years.
If not sooner. Hung,
Right.
final word.
Our title is Whatever Possible Impact on the International Monetary System. We haven't spoken too much on that. So I just offer my thought that one of the advantage and benefits of tokenized units, stablecoin, CBDC, is the speed and ease of transaction. And that means, in my view, the velocity of money will increase. And particularly in terms of in market stress time, it can jump quickly upward. And that will pose a problem for central banks. Because with the same monetary base, the same M1, if the velocity increase 5 times, that's a big inflationary push that will make life of central bankers very difficult.
Well, I'm very grateful that the Atlantic Council invited us all to come and speak. Particularly as I'm with the Council on Foreign Relations, we're very close to the Atlantic Council, but they do an amazing job and have another forum that will be hosted here shortly. Is there anyone left to save the global economy? Which I think, is a little bit of a dig at the IMF, since we're actually sitting in the IMF's building. But stay tuned, and thank you for joining us today.